welcome to Next Round with me, Dale McDermott.
And me, David W. Higgins.
A young Irish look at the economy, politics and society.
Covering home and abroad.
For the thinkers, the dreamers and the doers, this is Next Round. Hello and welcome to the latest episode of Next Round. This week we want to talk about the Apple court case on taxes. So Apple has been ordered to finally pay Ireland over 13.8 billion euro in taxes to the country. So we want to analyse that case and also what are the implications for this? Is this an opportunity to spend on some much needed major projects around infrastructure for the country, or are we better off saving it? Mario Draghi is also back. So the former president of the ECB and former prime minister of Italy is back, and he has authored a report focusing on the future of European competitiveness. And also, it is debate season, and last night it was the first and possibly the only presidential debate between the two US presidential candidates, former President Donald Trump and current Vice President Kamala Harris. So we want to talk about that as well. If you do like this podcast, please like, share and subscribe to us. We are available on all major podcast platforms. You can also watch us on YouTube, so please follow us there and subscribe to our channel. David, good to see you. I think we might start with the fresh news from this morning, where overnight in the US, the debate happened between Kamala Harris and Donald Trump. And it seems to be a bit of a kind of a bruising element again, where we're getting used to these testy exchanges now in presidential debates, certainly since 2016. Media commentary coming out of the US, and reactions seems to be that Kamala performed well after a nervous start. People mentioned she seemed to have a decent command of her brief across the issues. Donald Trump was somewhat more muted, focusing on policy, rankus at times, but didn't necessarily go towards the personal attacks which he has been attributed to. But he rose to debate on a number of issues. It seems to be the reaction from media this morning.
Yeah, so maybe the context going into this debate is important. The prior debate was the Biden versus Trump debate, and that's the one that led Biden to drop out of the race. So having left the bar so low that the Democratic candidate performed so poorly that he had to drop out, the bar was always low for Kamala in that sense as well, in that as long as she didn't trip up hugely, she was likely to emerge well from it. From what I can see, though, yeah, Trump has veered into some obscure areas of debate, talking about immigrants potentially eating pets.
Eating cats, I saw that.
Cats, yeah. And Kamala then landing some significant blows. I mean, one that I saw was on the abortion issue, talking about a woman potentially bleeding out and not being treated. I mean, it has echoes of the Savita Halappanavar case, which, was a big case which changed public debate on that issue in Ireland. It's very much a pitch for female voters on that issue, and this just calls to mind a report that I saw during the week, which looked at younger voters and how younger female voters are tilting heavily towards Democrats, but younger men have actually been tilting towards the Republicans, and that's why you've seen Trump. He's done a lot of interviews on newer media, going for younger influencers and doing longer form debates and kind of interviews with them. But on this debate itself tonight, there was a poll done by CBS, which found that Kamala was favoured to have won the vote by about 63% over Trump with the other third of the vote. So it does seem that she came out well from it. And I've seen some commentators, even in the Fox News realm of the world, saying that Trump underperformed. So that seems to be the mood coming out of it.
Yeah, no, and of course I think the question mark will be, what significance will this have on the outcome going forward? Nate Silver, the pollster in the US, is someone who I've been following for quite a while. So he's the founder of Real Clear Politics in the US. And back in 2016, he was one of the outliers where he always advocated for caution for the seemingly common view that Hillary Clinton was going to win. He deviated from that. And he's since been doing his own thing again, and he has been again advising caution going into this debate as well, where his polling believes that he thinks that Trump is actually doing well, that momentum has been with Trump for the last couple of weeks. And again, this is a battle of the Electoral College, and the key states which Kamala Harris needs to win, the likes of Pennsylvania, are actually edging towards Trump, according to Nate Silver's analysis.
Yeah, Nate has a real form in this area. He created the model used by the 538 website, which in 2008 and 2012 predicted, first got 49 out of 50 states right, and then in 2012 got 50 out of 50 states right. Now in 16, everyone's model was off.
Mm-hmm.
No one had Trump winning, but his model gave Trump the highest probability of winning. But polling in the US has seen even a further decay since at the 2020 election, which Biden won. Trump was quite heavily underestimated in the polls. He very much outperformed the polls, even though he lost. He lost to Biden. He was kind of misread by a lot of polls. And what pollsters are finding is that they're struggling to get good samples with enough MAGA Republicans in them. And in the same way that
He's
MAGA
always been
Republicans are very,
overstated, right? Or he's been understated in many of the polls, right?
yes, at least at the 2020 cycle he was. And you really don't know in this cycle until people actually go out and vote, right? And the risk that a lot of pollsters see is that they're finding that for telephone interviews and polls, that a lot of MAGA Republicans just slam the phone down in the same way they're anti-establishment and they distrust many institutions. They also distrust pollsters. And pollsters are trying to find different ways to correct this. So one thing, so typically pollsters will get a sample by certain demographics. So you get enough women and men, you get enough people of different age groups, you get enough people of wealthier and poorer groups. And when you create a decent sample, you should have a representative basket of the electorate. But what the pollsters are finding is that many Republicans, hardline Republicans, are just not partaking in the polls, meaning that their samples are actually off. Now, one way you could correct for this is saying, okay, let's get a mix of people who in 2020 voted for Trump or Biden and get that proportion right, and then you'd have a good sample. Problem with that is that people are notorious for actually lying essentially on how they voted in a prior election. There's a tendency for people to say, yeah, I did vote for Biden, I voted for the winner. So pollsters are really struggling here to get an accurate sample. And we may still have a race where Trump is heavily underrated and may actually be ahead.
Yeah, and this also might be a case of this might be the first and only debate, as I mentioned at the start, between both of the current candidates. I use current on purpose.
Yeah,
there.
And this still is because, like, they've in principle they've signed up to more than this one, but they may find that, well, Trump in particular may just find he doesn't want to go up against her again and just keep campaigning.
Exactly.
So that's the risk.
But the net from this is that Kamala performed better than people had expected. Trump took the bait more than he should have. And probably nets out, I don't know. My feeling is this kind of nets out into pretty much evens for evens. And won't have a material effect because no one really landed that killer blow, or got that killer quote. I saw Trump. He did mimic Kamala's "I'm speaking" piece, which I saw was floating around online this morning. But again, nothing of significance. Nothing that really was a killer.
Okay. And I'm presuming that none of them came out big heavy hitter and said, well, we need to stop Ireland taking all the corporate tax money.
No,
We
they
didn't
didn't.
feature.
They didn't. But this is something which I think definitely has caught the attention, as it did back in 2016 when this first was initiated. So just to remind listeners and viewers that what we're talking about is Ireland is awash with money, but it's been money, 13.8 billion euro, that's been sitting in an escrow account since then, as the legal battle between Apple and the EU has been taking place. So, just to remind everyone about this, this is about the European Court of Justice, so the highest court in Europe. Gave a view that the original finding on Ireland's tax structure, which Apple was utilizing to effectively exclude profits generated from intellectual property held by its international and European arms, amounted to illegal state aid. So just going back to this, what this amounts to is, at the heart of the matter, the allegation was that tax arrangements specifically helped out Apple to pay an ultra low tax rate, effectively 4%, on nearly $200 billion worth of foreign profits that it earned over a 10-year period. About 90% of Apple's foreign taxes, foreign profits, were earned by its Irish subsidiaries, which and the reason that happened was because they exploited a bit of a legal quagmire in which the Irish entities paid little tax because they weren't really tax resident anywhere, which was a structure which allowed them to exploit the difference between the US and Ireland. That has since been regularized and closed. So this doesn't really have an effect in terms of a sudden shock or a sudden policy situation, but it does draw attention to Ireland's tax affairs globally. And I'm sure the foreign direct investment managers in Ireland and those who are responsible for, attractiveness of Ireland abroad will be thinking about what are going to be the implications for this. But the net of this is that Ireland now has 13.8 billion euro, which it'll be receiving in the coming months, and it needs to decide what it can do with it. David, one thing I was looking at was, it's a shame this is taking so long, because if we had that money, there's very different ways that we could have invested it. If we tagged it to, let's say, the S&P 500, that would now be worth about 27 billion euro. If we put it into Bitcoin, it could have been over 900 billion euro. But we now have a situation where we'll have the money now over the coming months, and the government needs to decide, should it spend it or should it save it?
Yeah, well, the one thing that's off the table immediately is spending it on current day-to-day spending. That's just off the table because of how this money has been received. So it opens up avenues like, for example, paying down the national debt. It could then be reinvested. As you said, it probably could end up just going into one of the new sovereign wealth funds and reinvesting there. And maybe in time, I mean, effectively, this does just free up more money for capital spending. Even if you don't spend that money directly, you just, instead of saving all the corporate tax money. So what does Ireland do? And we have surpluses. We're saving those. Okay, well, instead of saving those, you could just pocket the 13.8 and then spend more of the corporate tax money that's coming in today. So that's some of the avenues that are open to you. So actually, in the round, I'm saying that you technically can spend it on day-to-day spending. But look, I mean, that's what governments have at their disposal with the large corporate tax bill income that we just have right now.
Yeah, but I suppose the difference is this is a bit of a windfall, and we know that the money is there, and it's a significant amount in one go that hasn't been allocated to anything. So it's net new, it's fresh, and it means that the government now has the ability to spend this as it pleases. There will likely be pressure on government to to think big on this. Do they put it towards major public expenditure? I mean, the metro in Dublin is estimated to be around, I think, about 13 billion anyway. So we basically have the metro paid for if we are to take that view.
Yeah, my guess is you'll end up with just about half a metro, just with the way cost projects have gone in Ireland. I know we discussed
A
this
one-way
about
metro, maybe. Yeah.
Yeah, exactly. Yeah, yeah, or build a monorail.
Or build a monorail. Exactly. Yeah. Well,
But
yeah, go on.
no, I was just going to say. So there's the debate on how you spend this money now that you have it, but there is this question of, okay, is this a big fallout and risk to Ireland's competitiveness or our attractiveness, call it, for foreign direct investment? What the ruling? Why did this ruling come about? It came about from the European Union's competition side, and their ruling back in 16 was quite significant in that sometimes state aid is where uh, yeah, countries have effectively subsidized, given direct cash to certain businesses and favored them. This was a ruling over the tax case, but over the tax side, but crucially wasn't on a particular policy. It was on an individual decision by the revenue commissioners. So it goes, it's quite invasive in that it sets a precedent whereby the European Commission can now, in future cases, come in and look at specific decisions by specific bodies in a country, as granular as revenue making a decision for a particular company, and make a ruling on whether that is a favorable deal for one company or a fair treatment for all companies, right? But is this a risk to Ireland's FDI and everything? I mean, look, our main competitors in the European Union are other European Union countries, obviously. So if another country comes along with a lower corporate tax rate, I mean, Hungary has already a lower corporate tax rate. Other countries might, in time, ever try to set it lower too. But all of those countries now carry that same risk. So, what you might say is, oh, a country like the UK, which is now outside the EU, might be a big winner from this. But I mean, as you said as well, Dale, this particular tax issue has been closed off. So our competitiveness on tax kind of we still have the same standing in present day.
Yeah, and I think that is the key distinction here, is that in 2016, there was a cleanup of the double Irish and the various other tax measures, which are applicable more so in this case. So it's more of a legacy issue. It's more that it's settled, but it does speak to the fact that where to now for Ireland. Are we, for the last 40 years, a big success of our industrial policy has been attracting large, predominantly US multinationals into the country because of our preferred tax location and situation. But in the light of going beyond that, is that good enough now, or what do we need to do going forward? We're a country that has, again, deep problems from an FDI perspective, with respect to housing and respect to infrastructure. This has been linked. The IDA have commented more recently that these are being seen as now challenges to continuing to attract that foreign direct investment into the country. Where to now for the next 40 years for Ireland's industrial policy remains to be seen.
Yeah, I mean, like I suppose the bigger issue you need to bring in there is the BEPS process at the OECD level,
Mm-hmm.
whereby Ireland now has to have 15%, not 12.5, and the attempt with those processes are to create a floor under corporate tax, whereby countries can't have a race to the bottom anymore. I mean, Ireland never went for like in the single digits. 12.5 was always a firm level, and we weren't looking to kind of slash below that. But by particular tax arrangements, Apple was able, in this case, to create an even lower tax rate. So there are attempts to correct all of this, but this was being said a decade ago or many years ago that all these processes were going to make Ireland relatively less competitive. But really, all the tax stuff it matters whether you're the leading country, and Ireland continues to be the leading country. Our gap vis-a-vis other countries might be closing and narrowing, but it's only really going to become an issue if another country significantly goes below us and begins to attract companies in that way. And you also have the fact that we're English speaking, common law, track record of being a good place for international business. It's hard for newer countries to come along and sweep the carpet from under us.
And that piece you mentioned about the global attempt to tackle this corporate tax issue, the OECD had that 2-pillar plan. One part was around low tax jurisdictions, and the new world agreed rate under the OECD of 15% meant that Ireland had to shift it from 12.5 to 15%. Agreed and was successful. But the other part, which was looking at the requirement for corporations to pay tax where their customers are located, which would have a net result of having some corporate tax leave Ireland, that is effectively dead and actually will not be moving forward under the OECD's
yes,
plan.
Yes. And that whole process has kind of, there used to be this risk that at the European Union level, there would be common consolidated corporate tax base was the jargon at the time, but it was a big push by the French in particular, but also some other Central European countries to say, look, Ireland is booking all the profits, but on revenues that are all across Europe. So the French were coming along and saying, look, let's take a company like Google, big advertising revenue that takes place in France from French companies. The profits should be charged to the French revenue system, but they get charged through Ireland instead, and Ireland keeps the corporate tax money. So there was always this move to try and make headway there, but that was something that Ireland could always veto. And to this day, we still can. So it's kind of gone to the OECD level instead. But funny, I know we're going to talk about this next, but Mario Draghi in his report, which has come out, one of the things he's talking about is ending national vetoes and going to qualified majority voting.
Right, yeah.
Which, if it did happen, would potentially leave Ireland exposed on that issue. So we're not over all this issue yet.
No, we're not. But this case comes at a well-timed ending, I think, for Commissioner Vestager, who was the commissioner who oversaw this case and led the Commission's efforts on tax evasion and avoidance for corporations operating within Europe, and even she said in her press conference when the ruling was given yesterday that if you were to take Ireland today, this Apple case would no longer occur because the Irish government changed its corporate tax residence rules to prevent Irish incorporated companies from being stateless. So again, I think the net point is Ireland, probably part of it was to save face, part of it was because I think they wanted to just defend the tax policy of the government for the last number of years, was that they had to take the case and defend the case as much as they possibly could. The key difference as well was the allegation was for on illegal state aid was that it wasn't just that the policy was preferential, but specifically for Apple. Did Apple get a special deal from the government was part of the allegation being made. And the Irish government, I think, was mostly at pains to deny that. But the net result of this is that, as I was alluding to a moment ago, it's done. It's dusted. I think, moving forward, they have a nice windfall that they weren't expecting. The case would not take place again if it was to happen in present day. And they can probably draw a line under the sand on this, I would imagine.
Yeah, I think so. I think, look, we move on from here. Government gets that arduous, luxury problem that we talked about last week of how to spend money. It's not a big problem to have. And I think we can keep this money and also still have a very competitive environment for multinationals.
And I think that's the external piece, but the internal political piece, though, I think, David, is that, the government has always been a little bit on the back foot on this in terms of, it's a really complex case. I mean, even explaining tax and reading what the case is complicated. Stateless companies, revenue being booked in certain countries. I mean, to the layperson who doesn't, who was no reason to be exposed to tax law, might not fully get it. But what they see is a government that was alleged to be in cahoots with a multinational, and was fighting not to get taxes paid to them. So I wonder how that affects the realpolitik, because now they have the money and now they have to spend it, which I think will be interesting.
Oh, I get what you mean. Yeah, I mean, look, this is the opposition argument, which was that we should have just accepted this money, and now fighting not to keep it makes it look like you didn't want to have that kind of money. I think the government will be okay, just because they are the government that is now presiding over record high corporate tax take in present day, and are running huge surpluses. And really, when it comes to the credible, if it is an election issue of, hey, who's best to keep that money flowing in, well, I mean, there's no greater government with a record of it than the present one.
Yeah, absolutely. Mario Draghi, David, you mentioned a moment ago. So Mario Draghi is back. So the former president of the ECB and the former prime minister of Italy was requested by President of the European Commission, Ursula von der Leyen, to write a report on the future of European competitiveness, which was released earlier on this week. It is over 400 pages in length, which, David, I'm sure you studied word by word in depthly. But really, I think, gives a breakdown of perspective across various sectors, from innovation, energy, EU governance, and also EU industrial policy. But some of the key pieces that it highlights is really around economic growth and the productivity challenges facing Europe. And it really, I think, calls out the fact that the EU has been really sluggish with respect to comparing itself to the US and China in economic terms, but in particular with respect to productivity and technological innovation over the last number of years. On the productivity gap, he's making a call for a significant reinvestment and increasing investment in innovation. And with respect to other parts of innovation, he's really calling for over 800 billion of investment to boost productivity across Europe. Other elements around energy and energy policy and supply chain and trade policy and how we need to reform that. But there is a piece here which is around governance, which I'd love to explore a bit, which is around some calls for possible treaty change, and how the EU functions as an entity in terms of how we make decisions. Do we move from unanimous voting to qualified majority voting instead? But then also Eurobonds have made a bit of a return as well, David, in terms of how do we fund all of this and how do we collectivize all of it, which I'm sure will give the northern countries a big scare. But then also the other piece, which I think is interesting, that Mario Draghi calls out, which is EU law scrutiny and how national parliaments are not really scrutinizing EU law as much and are almost using EU law as a crutch when they should actually be where EU legislatures across Europe might be better placed to make these laws versus depending on Europe to create them themselves. So a lot in it, David, a lot of pressing elements. Where do you want to start?
Oh, where to start? I mean, Europe, the current macro picture in Europe is a bit better than it was last decade, but is still quite sluggish. So, growth has, like most Western countries, we've recovered out of COVID. There's still buoyant growth, but not very strong growth in across the eurozone. But they're still very high debt levels. So debt to GDP in France, Italy, and Spain all exceeds 100% of GDP. That's past what economists would call the danger zone, where if your debt's too high, it tends to weigh on your economy. Germany is one of the major countries that isn't at that level, but all four countries continue to run government deficits. And we take Italy, the country where Mario Draghi is from. I mean, the percentage of GDP funding requirement they have called the deficit. It includes some other things, but you're talking about 8% of GDP into next year that Italy is borrowing. And so countries like that actually have very little wriggle room to massively grow their investment. At least in the short term, it's going to need to be a longer term thing. And if you are going to go down that road of piling even more debt on Europe in the hope that it'll lead to growth, you may be risking a very dangerous trade-off. I mean, why do countries grow debt? They do it so that you should also then generate GDP. But what Europe has done is it's generated debt, but hasn't then generated the GDP. And I know a lot of that generation of debt has been to pay for current spending. There's quite high pension bills in a lot of these countries, for example, and they have aging populations much more strongly than Ireland does. But I think he's right to say that if a turnaround in investment happened, it would be the right thing for Europe. But orchestrating that's going to be very, 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 very challenging.
Mm-hmm. Absolutely, yeah. And then the piece around, and he's speaking in as former central bank governors do in banker speak, where in some cases, I think once again Europe is at this big inflection point of where does it want to go? I mean, structurally, it has a challenge of it's not exactly a country. The euro is a currency without the fundamentals of that country's structure. Which leads to fragmentation. It leads to the inability to make common decisions about where they want to go. And again, pieces around economic policy, trade policy, the productivity gap, which was really called out in the report between the US and also to an extent China. Does Europe have the ability to sing from the same hymn sheet on all of these issues, or are we doomed to dither and delay as we have been doing for the last 20, 30 years?
Well, I think the one thing that this report might catalyse is a wake-up call for Europe on some of its regulatory adventures. So Draghi calls out two regulations in particular. One is around GDPR and the other is around AI. And on GDPR, he basically said that has probably weighed on the potential of smaller tech firms to establish themselves in Europe, but that it's probably been a boon for the larger ones that have the scale to be able to absorb the costs of it. But then on the AI side, he highlights that as an example whereby the approach in Europe has not just been to regulate problems that have arisen, but also anticipate future problems and try and pre-regulate them. And he, I think, speaks about this as being a kind of overregulation where, look, okay, AI is just emerging. If you put in hard regulations at the start, you're probably not going to have much AI innovation taking place in Europe because firms just won't feel that they have the flexibility to, move fast to break things. To take that famous phrase from Mark Zuckerberg of Facebook. I mean, you need to be able to be very creative and innovative to be able to create new things that last. But in doing so, you need a lower regulatory environment. And Europe doesn't currently provide that in a strong way. So I hope there's a wake-up call there.
Yeah, and I'd be curious to just even hear some listeners' reactions, maybe some listeners who have a small business on GDPR, because on this specific point, I saw a number of people who study this space but also have small businesses, and they felt actually that the focus on GDPR was actually not exactly warranted. That in reality, they said fairly simple, but in terms of how it's interpreted and applied then by small businesses can be unnecessarily overly done. Now, I'm not sure I agree with that, but I'd be curious to hear people's reactions on that. But on the broader theme of regulation, Draghi calls out that the Commission's legislative activity has been unnecessarily growing and high in nature. But he blames the passive nature of national parliaments who are not, triggering the so-called yellow card procedure, where basically they say that actually, national laws are better placed um, to to solve this legal issue rather than relying on the EU to do their bidding as such. And I think the question then is, why are national parliaments not, focusing on EU law more than they are right now?
I think competitiveness isn't sexy. So when bills come down to national parliaments and they relate to the intricacies of how a firm might operate, there isn't enough political capital to be spent for political parties in those national parliaments to actually speak up and fight against them. However, just thinking of some recent examples, I mean, like where there has been pushback on national parliaments has been on areas like trade. So the CETA, the Canada trade deal, which you'd be familiar with, Dale, that was one that received big pushback in Ireland, and pushback from Green TD.
It's still not ratified.
Yeah. And that's because there was this dispute over there being an investor court.
That's right.
And the risk being that firms would have too much power to they'd be able to sue governments essentially over regulation. So whenever an issue like that comes up, you'll find national parliaments are actually quite vocal on things. But if it is something as mundane as increasing some extra regulatory burden on a business, it just isn't politically sexy to push back. And that's where these things can kind of snowball. Something gets brought in from the Commission, passed by the Parliament, approved by member states, passed down to national national parliaments, and the whole thing is just a slow drift where there isn't enough. There isn't, like, being a business lobby just isn't sexy, and to push back on something is is hard to do.
Law isn't sexy. is the message here, is it?
Yeah.
Okay. But like,
not everyone watches Oireachtas TV or C-SPAN, right?
They don't, and they're better people for it.
Yeah.
But I think overall, though, the piece then as well, which kind of you're seeing threads being pulled through the report as well, is this collectivization as well, collective responsibility, and Eurobonds was the other piece which I think came out from it. And Eurobonds, they've been up for discussion for many years now, but they've always been resisted. The northern countries, predominantly those who are the givers of Europe, have been at pains to really avoid this from happening. Instead, there have been other alternatives instead of Eurobonds in place. The European Stability Mechanism, of course, is one. And the Next Generation EU Recovery Fund, effectively temporary funds designed to, kickstart Europe again, have been created. But they're not the same as Eurobonds, and they're not kind of the enduring collectivization which Mario Draghi seems to be calling for.
Yeah, and there's still big divisions between Northern Europe and Southern Europe on this, because a country like Germany, for example, would effectively end up paying a higher interest rate on its debt, vis-a-vis the South, because country risk has to go somewhere. And when you have countries in Southern Europe like Italy and Greece still having very high debt levels, there needs to be a premium on their debt. And so even though Eurobonds collectively would take everyone's interest rate down overall, it's going to lead some northern countries to notch a bit higher. And for that reason, it's kind of off the table in a way for now. But it's important that the kind of campaign is kept up. You mentioned the Next Generation EU fund. I mean, that has been very much a success. That in Southern Europe is notching, even more than 1% of GDP onto countries over the next couple of years out to 2027. It's a remarkably large package. And maybe if something at the European Union level came towards investment, that could be something, because that is a collective approach. That could be something that does spur the investment boom that Draghi wants to see. But we're not in a crisis anymore. We agreed the Next Generation EU during COVID, and even Northern European countries went on board with that. But asking those countries to say yes to another round of extra spending, when that money, the first round, has to be yet to be paid back, that's going to be a hard sell too.
Mm-hmm. Absolutely, yeah. The one other thing which was in the report, just on the whole theme of innovation, deep tech sectors like AI and quantum computing, he compared that they received far less funding when compared to the US. So only about 6% of AI funding and 5% of quantum computing investments are actually directed towards EU companies. While also here in the UK, what the new government have been targeting have been those emerging sectors, AI, quantum computing, and those seed companies that are all situated around the Oxford Cambridge region. That's an area where the UK government feels that they can differentiate themselves and latch onto. So not only I think is the EU going to face continued pressure from the US, but also new pressure where the likes of the UK feel that this is a gap and an opportunity for them to go after.
Yeah, well said.
Well, with that, I think we are out of time this week, David. So again, thank you all for watching and listening. If you did like this podcast, please like, share, and subscribe. Your support means a lot to us. And again, we're available to also see us on YouTube. So our channel is there. Please like us and follow us there. Next week, David, you're on the road, I believe, and so am I. So we'll be dialing in on a remote setting with a different background, but looking forward to chatting to you then.
Yeah, looking forward to it too, Val.